Hey everyone, welcome back to The Explainer. If you're on the finance team or just joining us to learn the ropes today, get ready because we are officially kicking off Module 1 of our ASC 210 balance sheet training. I am literally so excited to guide you through this, mainly because the balance sheet isn't just some boring regulatory requirement. It is the ultimate foundation for absolutely everything in corporate finance. Seriously, whether we're tracking cash, evaluating risks, or trying to secure funding, it all starts right here. If you don't understand the balance sheet, you kind of just don't understand the business. So today, we're laying down that rock-solid foundation.
Okay, let's dive right into this. Here's our roadmap for today. We'll be covering the financial photograph, the concepts of own, owe, and equity, and the snapshot versus movie analogy. Then, we'll look at who is looking at these reports, and wrap up with the 4 vital signs of financial health. Let's get to it.
Starting off with Section 1, the financial photograph. I want you to think for a second about the daily reality of a business. It's basically pure, organized chaos. You've got hundreds, maybe thousands of transactions happening every single day. Inventory's arriving, cash is flying out the door, sales are being booked, loans are accruing interest. It's just constant, continuous motion.
So that leads us to a pretty massive challenge, right? With all that constant movement, how on earth do you capture a company's exact financial health in one single moment? Like, if a bank asks you exactly how much the company is worth on a random Tuesday at 5 p.m., how do you even answer that when the numbers are literally always spinning?
Well, the answer lies in this brilliant little concept. Think of it exactly like a photograph. It captures exactly what the company owns and owes at one single moment, not over a period of time. You see, the balance sheet is how we freeze time. We take all that chaotic motion, and at the stroke of midnight at the end of a month, a quarter, or a year, we snap a picture. The balance sheet shows us our exact financial position in that frozen fraction of a second.
Moving to Section 2, own, owe, and equity. Now that we've essentially frozen time, what exactly are we looking at in this photograph? Let's break down the 3 massive pillars that make up this picture.
So, the crucial point here is that this frozen snapshot really exists to answer 3 very basic questions. First up, what does the company actually own? These are your assets: the cash in the bank, the buildings, the inventory sitting in the warehouse, and even the money your customers still owe you. Second, what does the company owe? These are your liabilities: your bank loans, those unpaid supplier bills, your payroll obligations. And finally, what is left over for the owners after paying all those debts? That's your equity. It's the owner's share, their initial investment, and the profit kept in the business. Now, as a finance professional, correctly classifying these 3 buckets is basically your most critical job. If you accidentally misclassify a massive liability as an asset, you don't just make a little typo. You completely distort the reality of the company's financial health, which, as you can imagine, can have catastrophic legal and operational consequences.
All right, Section 3, the snapshot versus the movie. We really need to contrast the balance sheet with the other major financial statements so you never ever mix up your timelines.
Notice how clearly we can draw the line between our reports here. Look at the income statement, also known as the P&L, and the cash flow statement. These statements show revenue, expenses, and cash movements over a period of time, like a whole year or a whole month. They are movies. They show the action, the plot, the beginning, middle, and end. But the balance sheet? No action. It only shows what you own, owe, and your equity at one specific date. It is just a static, defining snapshot.
And that gives us this absolutely unbreakable golden rule. When you see a report header that says, as at 31 December, or as of a specific date, that is always the balance sheet. Income statements, on the other hand, will say something like, for the year ended 31 December. And trust me, the phrasing matters immensely here. Confusing a single date with a date range isn't just a stylistic error. It's a surefire way to give your auditor a mild heart attack. It leads to immediate compliance failures because it tells them you fundamentally misunderstand what the data represents.
Which brings us to Section 4, who is looking? Because let's be honest, taking a beautifully detailed photograph of your finances is kind of useless if literally no one ever looks at it. We have to explore who actually needs this data and why they demand it.
The frequency of preparing the balance sheet really scales with who's asking for it. On a monthly basis, you're preparing this for internal management and your own finance team. This is just for internal monitoring, keeping a close eye on cash flow. Quarterly, the audience expands. The board of directors and your banks step in. They're doing performance reviews and checking loan covenants to ensure you aren't breaching the terms of your debt. Finally, annually, the doors swing wide open.
Auditors, tax authorities, and all major stakeholders review the balance sheet for statutory reporting and making major investor decisions. And this just brilliantly illustrates why different readers look at the exact same document in completely different ways. Banks and lenders are inherently cautious, right? They look at the balance sheet to ask, hey, can they actually repay our loan? They're obsessing over the debt-to-equity ratio and covenant metrics. But you, the finance team, you are the guardians of the data. You're looking at the balance sheet asking, is everything recorded correctly? You're checking the exact same numbers, but your focus is entirely on reconciliations, classifications, and absolute completeness.
And here we are at our fifth and final section for today, the 4 vital signs. When those external readers we just talked about get their hands on your balance sheet, they're essentially acting like doctors reading a patient's chart looking for 4 specific indicators of health. Let's walk through these and see how they build a complete risk profile. Number 1 is liquidity. Does the company have enough current assets to pay its short-term bills? Number 2 is solvency. Is the total value of the company actually greater than its total debt? Number 3 is financial structure. How is the business funded? Because a heavily debt-funded business carries a much higher survival risk than an equity-funded one. And number 4 is the asset base. What actual resources does the business use to operate? The types of assets you hold tell the whole story of how you actually generate your income. I really want to zero in on that second vital sign for a second, solvency. This is the ultimate cliff edge of corporate survival. Solvency is defined as the state where your total assets exceed your total liabilities, period. If your total liabilities become greater than your total assets, it means the company owes more than it is entirely worth. When that happens, the company's technically insolvent. This is a critical distress flare. If the board or your bank see this metric slip, you better believe sweeping interventions are going to follow.
But, we have to be incredibly careful here, because businesses can face 2 very different types of crises, and the balance sheet reveals both of them. Look at this comparison. On the left, solvent but illiquid. Imagine a business that owns $10 million in pristine real estate, but they only have $50 in their checking account. They are solvent. They own way more than they owe, but they are illiquid. If payroll's due this Friday, well, that real estate doesn't matter one bit. They are in an immediate operational crisis. Now look at the right side. Liquid but insolvent. Imagine a business that just received a massive $2 million cash loan, but their total debts are now double the value of their entire business. They have the cash to pay Friday's payroll, so they are liquid, but they are absolutely drowning in crushing debt, making them insolvent. The balance sheet forces us to monitor both of these conditions separately.
So, we've successfully frozen time. You now know exactly what a balance sheet is, you know what it captures in terms of assets, liabilities, and equity, and you know how to read its vital signs. But there is one massive, foundational question we haven't answered yet. It's called a balance sheet, but why must it always perfectly balance? What is the mathematical law that dictates that every single time you run this report, both sides must equal out to the exact penny? Well, that brings us to the famous accounting equation. Assets equals liabilities plus equity. And that is exactly what we're going to unpack in our next module. Thanks for joining me on this explainer, and I will catch you in the next lesson.